if I told you that silver didn't just go up, it quietly disappeared while most of the world was busy watching stock elections and headlines designed to distract you. Right now, something is happening to silver that almost never happens in modern markets. It's not just rising in price. It's not just in demand. It's being pulled out of the system ounce by forces that don't care about charts, opinions, or retail investors. And once silver leaves the system, it doesn't come back easily. Think about this carefully. Markets can fake prices. Governments can print money. Banks can create credit out of thin air. But no one can print silver. When physical silver is gone, all that's left are promises, and history is very clear about what happens when promises collide with reality. For years, silver was treated like an afterthought, undervalued, overlooked, suppressed, called boring. But while people were laughing at silver, industries were consuming it, solar panels were eating it, data centers were demanding it, artificial intelligence was draining it, and now suddenly the world wakes up to one brutal truth. There isn't enough left. This is why prices didn't rise slowly, they jumped. This is why supply chains are breaking. This is why countries are changing policies. And this is why silver is no longer just a metal, it's becoming a strategic weapon. Here's the dangerous part. By the time silver becomes a mainstream headline, the easy opportunity is already gone. The real moves happen quietly in warehouses and shipping routes and government decisions that never make front page news, and those moves are happening right now. Today we're going to talk about why silver is vanishing from global markets. The biggest industrial powers are tightening their grip on it. Why silver is no longer just cheap gold, but the backbone of modern technology, and why this moment may be remembered as the point when silver stopped being ignored and started being unavoidable. So don't blink, don't skip ahead, because once you understand what's really happening to silver, you'll realize this isn't just a market story. It's a warning. Let me tell you something most people still don't understand. When silver crossed above 60D, it wasn't just a price move. It was a message, a loud one, a warning shot to anyone still believing that markets are rational. Currencies are safe and wealth lives inside numbers on a screen. Silver didn't politely climb, it broke out. It forced its way into history, doubling in a single year. While most people were still distracted by headlines, politics, and promises from institutions that have been losing credibility for decades. Think about that for a moment. For years, silver was ignored, manipulated, laughed at, called boring, called too cheap to matter. And yet, while people were chasing paper gains, silver was quietly being drained. Ounce by ounce from the real world, mines couldn't keep up. Inventories thinned. Industrial demand kept growing. And then suddenly the dam cracked. This wasn't speculation. This wasn't retail hype. This was pressure finally escaping. Silver moved faster than gold because silver isn't just money. It's useful. Every solar panel, every data center, every electric vehicle, every advanced circuit needs it. You can't print silver. You can't substitute it easily. And you can't build the future without it. When the world accelerates technologically, silver feels the strain first. That's exactly what you're seeing now. Gold, as always, moved with dignity. It rose because fear rose. Central banks bought. Nations hedged. But silver ran because it sits at the crossroads of fear and necessity. When investors want safety and industry wants supply at the same time, something breaks in 2025. That something was the old price ceiling everyone thought would hold forever. More than doubling in 1 year isn't normal. It's not healthy, and it's not accidental. It's a sign that the system waited too long to acknowledge reality. Years of paper contracts, leverage, and artificial suppression met a physical world that finally said no more. Here's the uncomfortable truth most people don't want to hear. Prices don't explode like this unless they were wrong for a very long time. Silver wasn't expensive at 60 or it was mispriced at 20. And when mispricing collides with scarcity, the correction isn't gentle. This is how wealth transfers happen. Not slowly, not fairly. But suddenly, the people who understood that money is not currency were early. The people who understood that real assets don't need trust were calm. And the people who waited for confirmation are now asking the most dangerous question in investing. Is it too late? Silver's breakout isn't the end of the story. It's the beginning of a new chapter, one where hard assets remind the world that value doesn't come from belief, policy, or promises. It comes from reality. And reality just repriced silver in a way history will remember. The only real question now is simple. Will you learn why this happened, or will you explain it away after it's already changed everything? Here's the part most people completely miss when they look at silver prices. Price is the symptom, not the cause. The real story is happening far away from trading screens inside warehouses, supply chains, and balance sheets that don't get airtime on mainstream news. And right now, one of the biggest shock waves is coming from China. For decades, China quietly played the role of stabilizer in the silver market. Supply tightened elsewhere, China had inventory. When demand surged, China absorbed it. When prices wobbled, China's physical stockpiles acted like a shock absorber for the global system. That silent buffer kept silver appearing abundant, even when it wasn't. That buffer is now disappearing. China's silver inventories are plunging to levels that would have been unthinkable just a few years ago, not shrinking slowly, draining. And when the largest industrial consumer on the planet starts running down physical stock instead of exporting it, that tells you everything you need to know. This isn't speculation. This is necessity. China isn't hoarding silver for fun. It's consuming it. Solar expansion, electrification, high-speed infrastructure, advanced manufacturing, data centers, all of it eats silver relentlessly. And unlike paper assets, physical silver doesn't recycle itself fast enough to keep up. Mines take years to develop. New supply doesn't appear because prices go up. Reality moves slower than markets. Now here's where the system starts to crack. For years, the global silver market operated on the assumption that physical shortages could always be managed. Paper contracts, futures, derivatives, promises stacked on promises. As long as someone somewhere had inventory, the illusion held. China's inventory was the anchor holding that illusion in place. Once that anchor lifts, the whole structure floats, and floats don't feel stable in a storm. A structural shortage isn't a temporary imbalance. It's not a bad quarter. It's not a logistics hiccup. It means demand is permanently larger than available supply at current prices. And when that happens, markets don't negotiate. They rhetoric aggressively. This is why silver didn't rise politely. It jumped. Because when China stops acting as the world's safety valve, the rest of the world feels the pressure instantly. Fabricators scramble. Industrial users compete with investors. Governments start paying attention, and suddenly everyone realizes they're standing in line for something that no longer exists in surplus. This is the danger of just-in-time systems in a just-in-case world. The global economy was built on efficiency, not resilience. China's inventory plunge exposed that weakness overnight. There is no emergency stockpile large enough to calm markets when the biggest player decides it needs the metal more than it needs to sell it. And here's the uncomfortable part. Once inventories are gone, they're gone. You don't refill them quickly. You rebuild them over years at much higher prices. This isn't panic. This is math. This is physics. This is reality reasserting itself after years of denial. Silver didn't become scarce overnight. We just ran out of places to pretend it wasn't. When governments change the rules, markets don't ask for permission, they react. And when the government making those changes happens to be the largest industrial force on the planet, the reaction doesn't stay local. It ripples outward fast and unforgiving. That's exactly what's happening now as China quietly but decisively reshapes how silver is treated inside its economic system. For years, silver moved freely enough to maintain the illusion of abundance. It flowed across borders as a commodity priced by markets that assumed supply would always show up when needed. That assumption is now under stress by tightening export controls and treating silver less like a simple metal and more like a strategic resource. China sent a clear signal. This is no longer just about trade. It's about security, technology, and national priorities. A country starts classifying a material as strategic, it changes everything. Strategic assets aren't sold cheaply. They aren't exported casually, and they certainly aren't left vulnerable to foreign shortages. Silver now sits in the same conversation as energy, rare earths, and critical infrastructure materials. That alone should make investors stop and think. Markets hate uncertainty, and policy shifts create exactly that. Traders suddenly have to price in political risk, supply restrictions, and the possibility that physical metal simply won't be available at any price. Volatility spikes, not because people are emotional, but because the old model stopped working. You can't arbitrage what you can't access. This is where most people misunderstand what's happening. They think higher prices are driven by hype or speculation. In reality, prices are adjusting to a new rule book. When exports tighten, supply shrinks outside the source country. When supply shrinks, competition increases. When competition increases, price becomes the only rationing mechanism left. Investors around the world noticed immediately, not because they suddenly love silver, but because they understand power and control over resources as power. When China decides silver must serve domestic priorities, first manufacturing, energy transition, advanced technology, global markets are forced to accept what's left over, not what they demand. This is how financial pressure builds quietly and then releases violently. You don't see it in press conferences. You see it in warehouse withdrawals, delayed deliveries, widening premiums, and paper promises that start to look fragile. The more strategic silver becomes, the less willing anyone is to part with it. And hoarding doesn't start with panic. It starts with policy. There's a bigger lesson here, and it's one history teaches over and over again. Governments don't protect things they believe are plentiful. They protect what they believe will matter in the future. China's policy shift isn't random. It's preparation for a world where technology, energy, and geopolitical leverage depend on materials that cannot be printed or replaced. Markets are simply catching up to that reality. Volatility is not a flaw in this environment. It's a feature. It's the sound of the old system adjusting to new constraints. And once a metal moves from commodity to strategy, it rarely goes back. Silver didn't just get more expensive, it got more important. Silver is making noise and grabbing attention. Gold is doing something far more powerful. It's holding its ground at historic heights without needing excitement. Above $4,000 an ounce, gold isn't shouting. It doesn't have to. Gold never begs for attention. It simply sits there calm and unbothered while the world around it gets louder, riskier, and more unstable. That strength tells you something important. Gold doesn't move because people feel greedy. It moves because people feel uncertain. And right now, uncertainty isn't a headline. It's the foundation of the global system. Central banks know this better than anyone. They don't buy gold for short-term profit. They buy it because they don't trust paper promises, political cycles, or financial experiments that look good on spreadsheets, but collapse under stress. Central banks are buying gold at record levels. They're not speculating. They're voting. Voting against currency debasement. Voting against uncontrolled debt. Voting against a future where money is created faster than value. Gold above 4,000 isn't a bubble. It's a signal that trust is quietly leaving the room. Geopolitical tension adds fuel to that fire. Trade wars, regional conflicts, sanctions, fractured alliances, none of this gets resolved quickly. And every time uncertainty rises, gold absorbs it like a sponge. Not because it reacts emotionally, because it has done this job for thousands of years. Empires change, systems reset, gold remains. Makes this moment different is the macroeconomic backdrop. Governments are drowning in debt. Interest payments alone are becoming unmanageable. Growth is slowing, but spending isn't. When leaders face that trap, they choose the same solution every time. Dilute the currency and hope nobody notices. Gold notice. That's why gold's strength is quiet but relentless. It doesn't need parabolic moves to prove its point. Holding above 4,000 while markets swing wildly is a display of confidence, not in the system, but an escape from the system. Gold isn't betting on growth, it's betting on preservation. And here's what most people still get wrong. Gold isn't competing with silver. They play different roles. Silver reacts to stress in industry and supply. Gold reacts to stress and trust. When both are strong at the same time, it's not coincidence, it's confirmation. It tells you the problem isn't isolated, it's everywhere. Gold's strength also exposes the weakness of traditional savings. If gold can sit at these levels without panic buying, imagine what that says about cash losing purchasing power quietly in the background. Inflation doesn't need to explode to do damage. It only needs to persist. This is why gold doesn't collapse when fear fades for a week or two. The fear isn't temporary, it's structural, and structural problems require structural hedges. Gold above 4,000 isn't a finish line. It's a checkpoint, a reminder that real money doesn't rush, doesn't argue, and doesn't need approval. It simply waits, while everything else proves why it's necessary. For a long time, people made the mistake of putting silver into a single box. They treated it as a cheaper version of gold, a speculative cousin useful mostly for coins, bars, and short-term trades. That thinking is now obsolete. Silver has stepped into a completely different role, and the world is only beginning to understand the consequences. Today, silver isn't just money, it's infrastructure. Every solar panel needs it. Every data center expanding to support artificial intelligence depends on it. Every electric vehicle, smart grid, advanced medical device, and high-performance chip requires silver's unmatched conductivity. This is an optional demand. It's mandatory. And mandatory demand doesn't negotiate with price. It demands supply no matter the cost. That's what makes silver so dangerous to ignore. Investors buy silver because they want protection. Industry buys silver because it must. When both groups show up at the same door, scarcity isn't a theory anymore. It becomes a physical problem. You can delay investment. You cannot delay production lines without consequences. And when technology collides with limited supply, prices don't rise gently, they gap higher. The global push toward clean energy alone is rewriting the silver story. Solar installations are accelerating worldwide, and silver is a critical component in photovoltaic cells. Governments can promise targets. Corporations can pledge transitions, but none of it happens without silver flowing through the system. You can't substitute it easily. You can't scale around it. It's embedded in the process. Now add artificial intelligence. AI isn't software floating in the cloud, it's hardware. Massive data centers, high-density chips, power management systems, and cooling infrastructure. All of it consumes silver. And unlike consumer electronics, AI infrastructure doesn't care about saving pennies on materials. Performance comes first, reliability comes first. Silver delivers both. This is why silver has become a dual-threat metal. It protects wealth while powering the future. That combination is rare and explosive. Most assets do one or the other. Silver does both simultaneously. And the market was never priced for that reality. Here's the uncomfortable truth. Industrial demand doesn't care if investors think silver is overbought. Factories don't stop because charts look stretched. Governments don't pause energy transitions because prices feel high. When strategic demand locks in, supply becomes captive, and captive supply changes behavior fast. This is where the idea of silver as a passive commodity breaks down. Silver is becoming strategic. Strategic materials don't trade freely forever. They get prioritized, stockpiled, protected. And once that shift happens, the old rules stop applying. People often ask whether silver is still cheap. That's the wrong question. The real question is whether silver is available in a world racing toward electrification, automation, and digital intelligence. Availability matters more than valuation models built for a different era. Silver isn't being consumed for decoration. It's being consumed for survival in a competitive technological world. And once a metal becomes essential to progress itself, it doesn't need marketing. It doesn't need high. It only needs time, because demand is no longer a choice and supply is no longer flexible. So here's the bottom line. Silver isn't just rising. It's breaking free from the old market rules. China isn't just a buyer. It's reshaping the global supply landscape. And gold, it's reminding the world that real wealth never dies. It just changes form. If you think this is just another market blip, think again. Witnessing a massive shift in the way the world values money, industry, and tangible assets. And when real money resurfaces, make no mistake, markets and wealth will never look the same again. Stay alert, stay rational, and always respect the metals. Because right now, history is being forged 1 ounce at a